And whoops, I almost forgot to start the recording. So I got the recording started, and now we can move on to the to sharing the desktop. All right, so hang on a second. We're going to hopefully get that working correctly. All right, fantastic. Hopefully you guys can see my Thinkorswim window. Everything looking good, guys? Can you see Thinkorswim? Someone, anyone? All you can do is type Y. Come on. Thank you. And don't type privately, please. Okay, please type to all participants so that everybody can see it. Otherwise, it seems like I'm talking to myself when I answer questions. Thank you, guys. Let's get going. All right. So the big picture story is, I'm sure we should probably go to the Morning Post. So let's go check out the Morning Post and see what it looks like. Oh, there it is. Fantastic. I think I have the big chart up here. Here it is. Could be bigger. Open in new tab. You guys know this trick? If you right-click, you open it in a new tab, and then you'll get a picture as big as it's supposed to be. All right. So the big story here is our bounce lines, and when you've got a drop, especially long range. In the short term, it's tricky because things can move for all sorts of reasons, but when you're into long-term patterns, the 5% rule tends to have a lot more pull than over the very short run. Oh, shoot. I hope Greg's on here as a participant. That would be helpful. We have to probably start doing that in the future. Howard, try rebooting. Let's see. Howard, try entering. Okay. Hopefully it's just Howard. Now let's see. So basically, you know, look, it's pretty simple though, because for the 5% rule, what you're looking for is consolidation. You draw your consolidation line. In this case, it was a 75 line over here. Then you go from top to bottom, and not bottom spike, but bottom consolidation. So, you know, around 25. So we got a nice 50-point line. Even if we have a 50-point drop, then your bounces are going to be 20% weak bounce, 40% strong bounce. Now, 50 is easy because then you're talking about units of 10. So you have 20, 435, and 445 of the units you're going to be looking for. Wait, I did that wrong somehow because I can't. I missed something here. This is 475. Oh, I'm sorry. That's 325. It's 150. Sorry, really made a big difference. So it's a 150-point drop, and with a 150-point drop, we then want to see 30-point bounces. So we're going to be up to 355 and 385. And see how 381? It's funny how that works out, right? So 381 happens to work out to be the 50-day moving average. Now, as the 50-day moving average continues, it's going to top out right at 385, which is our 5% rule bounce. You guys, oh, you do have all participants, I'm sure. Hang on, if you look at your thing, you got to scroll it down because it says host and presenter, all attendees, all panelists, and then below all panelists is all participants. You got to go down from the top. Okay, but I'm sure it's there. So anyway, so that you see how it's easy to calculate, especially when you have an easy number to work on. But the concept is always the same, and that goes any sequence you're looking for, it works because it doesn't matter. What matters is that there's a lot of trading. This goes back to the whole Fibonacci concept, is that if there's a natural movement into something, natural flow. You think of orders as being a flow. So there's a natural flow. Below all panelists is still Davis. You know, let me see what that is. All participants are all panelists. And it doesn't say all participants below Phil Davis. There's nowhere where it says all participants. But Wayne, you just said that to all panelists. I don't understand. You're actually talking to all panelists right now. Or all participants anyway. But, oh, I see. I'm sorry. No, all panelists is different than all participants. Silly me. Wow, okay. I understand what you're saying. I never saw that difference before. So you guys are talking to all panelists. It does not say all participants. All panelists only shows my own questions. That's okay. All right, well, I mean, there's nothing we can do about it. And that's really crazy, though. I don't understand how it... Oh, how about all attendees? Try all attendees. I'm an attendee. Can somebody say something to all attendees? Like hi, anything? No, you don't have that either. That's crazy. Well, I don't understand these people. All right, sorry, guys. All right, we'll have to figure this out. I think I'll just have to read your questions and whatever. So you guys can't see what, nobody can see what anyone else is saying. Is that correct? That's so weird. Okay. All right, sorry for the confusion. Me and Greg will have to figure this out with people over there. I can't believe that's how this thing's supposed to work, though. That would just be nuts. Whoa, what is that? Wayne said a great big thing. All right. See, this is the problem, because Wayne wrote like a paragraph. But let's read it. Sorry, hang on a second. Let me just get through my thoughts. All right. So, Fibonacci, right. Okay, so, you know, one thing you could do is look up what a Fibonacci sequence is in Wikipedia, or I've written previous articles explaining the whole concept of why Fibonacci works and what it's about and how it applies to what we're doing here. But the concept is just anything that naturally flows. And flows is a very broad term, because in Fibonacci, he's talking about like the growth of a flower, or the tide, or the movement of a tide, or the wind, or the spread of A to Z. You know, anything that flows, it has a natural sort of, it goes out and it pulls back, just like the ocean goes out and pulls back. Things will spread and pull back a bit, and spread and pull back a bit. That's what happens when people are buying and selling stocks also. They rush in, they pause, they rush out, they go more, you know, and so there are certain levels at which things will naturally start to retrace and retract. So think of it a little bit that way. But the only thing to worry about, what we're looking for as far as the rule goes, though, is that you're looking for, first of all, you can do this spike to spike. Okay, so if you want, you can actually look from one spike to the other spike, because they're both aberrant, and generally they'll even out anyway. Like, you know, if you are spike to spike numbers, they won't be too far off from the consolidation numbers. But in this case, would you call that a spike? Would you call this a spike? I would call this line 1150 a consolidation, unless for some reason, like, it hit a calculation point like 11,000. Because in this case, 11,000 is one of our 5% lines. But since that's such a broad line, even though this looks way over to your eye, this is short term, in the long run, this whole thing is a spike over. It means nothing. So you use the 11,000 line, and then the 11,000 line rolls down to 600, and you really had a 600. I'm sorry, you had a 400-point drop here. All right. So the longer your term, the more you want to use big broad lines. See here, you can't. You know, I'm not going to call that anything but 1,200. This is just a spike. It means nothing. And down here, I call this line 1120, but I would call it 1120 if I was looking at it as a line. But since 1110 is our actual line, and we tested 1110, I'm calling 1110. So this is a 90-point drop, and we have to make that calculation off a 90-point drop. So in a 90-point drop, what do we have? We have 18 points retracements. So you're going to be looking at 18 to 1110 to 1130. Well, again, I'm rounding again, but you know, that's another important thing to know about the 5% rule. It's not like exactly anything. These are all going to be, you know, approximations. So there's no harm in like rounding up 2 points out of 18. So I would look for I'm going to look for 1130, and that's what we did. We rounded up, and 1150. And so far, we're still failing that 1150 one. And the longer you fail it, the harder it's going to be to get over it. You're solidifying the resistance. And that means, that goes back to what we talked about before about the lines. But you have to understand how these averages get drawn. Forget, if you want to, you know, in other words, if you want to be a victim of a chart, then stare at all these lines till your face turns blue. But if you want to understand the chart and predict the chart, then you have to understand how these lines get drawn. And how these lines get drawn is every day that you're under this red line, and every day you're under this blue line, you're pulling that line down. It's an average. Every day you're under it, it's going to tick towards you just ever so slightly. The 200-day much more slightly than the 50-day moving average. But now in this case, what's going to happen in the bigger picture? If I stay below for a number of days, if I stay below this red line, even if I'm on the red line will flatten. But what's going to happen? The 50-day moving average will start ticking down. And what does it mean when the 50-day moving average ticks down and gets to the 200-day moving average? That's when you get what they call a death cross. That's a horrible technical signal. So it may seem innocent enough that you're consolidating. You may look, a lot of chart people say, oh, we're consolidating for a breakup because we're running along the 200-day moving average flat. But you're not if you're pulling the 50-day moving average down while you're doing it, because then you're creating a situation in which the pressure from the falling 50-day moving average is going to become more resistant. And once it crosses under, unless you happen to pop right over, and that is what happened over here, by the way. See what happened? We were consolidating over here, and the 200-day was still moving up because we were over it, so it was pulling it up. And the 50-day, though, came crashing down and almost crossed here. That would have been a very bad signal here. It didn't do that. It got saved, and now we're moving on here. All right, but again, it got saved, but in a very sloppy way. Here we are back down here anyway. So not pretty. So these bounces are just bounces. They're not even strong bounces, and we're not impressed by any of this kind of movement until we see something a lot better than this. And that's what I was writing about this morning. It's like, let's stay out of bad trades. All right, so I wrote lead is not into betting on bounces, because you have to just remember this is very tempting. You want to bet, you want to play, and you certainly want to play when things look cheap. You're like, oh, look at that stock, look at the Dow thing. It went down here, it looks so cheap. But look at the bigger picture. All right, so in the bigger picture, it's not cheap. Damn it. Oh, I got to stop this from happening. It's a stock chart thing I found out, but I can't make it stop. So in the bigger picture, it's not cheap because it only went down this little tiny bit. This is nothing in the grand scheme of things. So look at this fall down at this average. Did it over here, did it over here. It may go up. But how often can it pull this trick off? Are these Dow components really worth more money? Or have we maybe gotten ahead of ourselves and we need a real retracement? We haven't had a real retracement since way back here, when we confirmed 10,000 was going to hold, or 11,000 really. Oh yeah, I guess we confirmed 11,000 was going to hold. That's the last time we had a solid retracement. All right, and if you take 50% of 11,000, that's 5,500. That's going to take you to 16.5. Oh, look at that, 16.5. That's exactly 50%. That's the real run, okay? 11,000 to 16.5 is your actual run. This was an overshoot. This is where we should be. And the 200-day moving average is telling you that's where we should be. All right, 16.5 is the correct number. That means you can expect the Dow to go up and down 10% from 16.5. So that's up to 18, as much as 18, and as low as 15. All right, everybody's counting on 18, but nobody's even thinking about 15. But going down to 15 doesn't even violate the uptrend. You're still in the general uptrend if it goes down to 15. That's not a big pullback. It looks like a big pullback if we overshot the mark, but it's nothing. It's only a small variation. All right? So, damn it. I swear I took that off the hook. All right. And Wayne says, I would like to clear something up confusing. For the bounce rule, it's a 20% retracement of the drop for a weak bounce and 40% for a strong bounce, right? By the way, that bounce rule also counts for up, okay? It's a retracement, but it's the same thing. When you're going up, you expect the exact same move off the top. Same rules off the bottom, off the top. Any major move, you're going to get these kind of retracements. No. He says, you mentioned the strong bounce should last 2 days. There's no 2 days. There's no such thing. Okay? you really want to look at the period of the drop. So in this case, okay, the faster you come back, the stronger it is. The longer it takes you to come back, the harder it's going to be to crack that line. That's all. And it's relative to the drop. And as you guys know, there's a V-shaped recovery, right? That's recovery. A is a V-shaped recovery. That means the whole drop was bogus and will quickly reverse. So here's see how fast it comes back, down, up, up. That's a V-shaped recovery. A strong bounce on the second day, but it's off a 5-day drop. It's all relative. Then you went cracking up. You had predicted it right here. Strong bounce next day. As soon as you open over the strong bounce, you know you're in good shape. All right? In this case, no bounce. You know, very weak bounce, failure. Now we're making a weak bounce, below the strong bounce. And now we're kind of making a strong bounce off the whole thing here, but we haven't made a strong bounce yet. I forgot what the number was, but the strong bounce on the down was higher. Well, we can figure it out. We'll call 17.1, all right, to 16.4. That's 700 points, so let's call it 150 points. So 16.550 is weak. So all you've done here is a weak bounce. Now, so that means that we're probably going to get one of those W patterns here. We're going to go back to 16.4. But then that's okay, because after 16.4 gets tested again, you still have another chance to show that you're strong, because you're going to get that second bounce usually off of strong resistance, and the 200-day moving average should be good support. So you're going to get a second chance off making a W to show the up leg of the W. Now, the up leg should mirror the back leg. And let's say we have a good one. We don't really have a good one. We have B's here. We don't have W's. Let's take, I bet Apple's got one. Let's take a look at Apple. Yeah, kind of sloppy. Well, here's one. So Apple fell. It fell, consolidated, now it falls, makes a quick V here, comes back around, and now it's starting to make that W. Now, once it completes, here, once it does that, it's now showing a leg of the W. So you want to see this pattern matched on this side, and it was kind of, but in a little bit more of an aggressive way. And as soon as you see it being more aggressive here, then that means it's got a good chance of breaking. As soon as you break over the top, which again, turns out, it's not by coincidence. Again, the top here turns out to be, it's predictive of where the 200-day moving average is going to end up. 200-day moving average comes here, big test here, but as soon as you're over that line, you can predict good things for it. And it pops over, comes back again to test the same line again, and then takes off finally and asserts itself. All right, so again, it goes back to you have to understand why these lines get drawn, how they're affected. That's what helps you understand how the chart's going to look. Who cares how a chart does look? I care how it's going to look in the future. That's what my bets are going to be based on. All right, so the question is from Wayne. When you are still examining each end of the peak and trough, do you include the overshoot? Okay, we talked about that. No, you can include the tails if you're in short term. If you don't feel like doing the calculation, I can just take these two numbers and go like that, or if you don't see a clear consolidation, there's nothing wrong with it because everything averages in anyway. So it's often the case that your spike to spike is going to be the same. But if you have a really silly spike like this one to 53.97, way under the 55, you got to throw that out. It's silly. Okay, and this one, see this 76.08? How can you count 76.08? This is weekly, by the way. How can I count 76.08 when it reversed that quickly? And you're talking about a huge difference. That would throw all your calculations off if you tried to count that. Even if you say I'm going to count spike to spike, this spike was ridiculous. All right, these two spikes are both silly, but they cancel each other out more or less. So you just got to use some common sense. I mean, I wish there was a hard and fast way to say that, but no, you got to use some common sense with a significant move or not. Also, if it was Christmas Eve, I wouldn't count it because Christmas Eve, nobody's trading. Not that anybody's trading now in this market, but when the volume is low, it's insignificant. That's why we often talk about meaningless Monday. It's like, I don't care what happens on Monday. Like, I don't care what happened yesterday. It doesn't mean anything. There's not enough volume for us to care about the movement. All right. So, peak to trough. We include the overshoot of the closing price for that day. It's not about closing, it's not about overshoot, it's about where are you consolidated, it's about where you can draw a line. Yahoo, where is Yahoo? Is Yahoo. All right, so we go to Yahoo and we look at the chart. I like if you want to use lines, it's kind of easy on Yahoo. If you go like, here's a 5-day chart. All right, so I'm going to use 93.50. I like to use round numbers, so I'm going to use 93.50. You could argue 94, but I'll use 93.50. And I'll use, all right, let's call it 96.50. So I'll say this is a $3 range. If it's a $3 range, what's that pullback going to be? 60 cents, right? And what do we get? 60 cents. That's a weak retracement. I mean, this guy's strong. He's holding 60-cent line right there. Now, I want to pull back, though. And now I see what? Now I see 99 back to 94. That's $5. Well, that's easy enough, right? So we go from 99 to 94. Then I'm going to expect to see a $1 move, which is weak, to 95, and a $2 move to 96 is strong. So we are now completing on the bigger picture a strong bounce. So we have a weak pullback at the strong bounce line. 96 is a strong bounce line. That means Apple is consolidating for a move up at the moment. Now we pull back to confirm further. If you're in 3-month mode, you say we went from 84 to 99. That's 15. And if it's 15, it means we expect a $3 pullback to 96. Ooh, look at that. And then we expect a $3 more pullback to 91. And wait, I'm sorry, 93. And there's 93. And we bounce hard off the strong pullback. So again, another bullish sign. So we're getting bullish sign after bullish sign after bullish sign. At each level, we pull back. And if you go back a year, you go back 2 years, and just keep looking back and finding a significant spot each time. And as they keep confirming each other, you say, hey, I think I might be onto something here. All right, so Apple's looking bullish. Not sure whether high or low close. Now, if Apple's bullish, the whole market's bullish. This is an interesting thing, though. If Apple is bullish, then the whole market should be bullish because Apple jams up the NASDAQ and Apple jams up the Dow. So that's why we're not going short. We're kind of trying, what we're doing right now is we're hanging on, not just Apple for several reasons, but we're not trying to hang on. We're trying to hang on to our longs because the market's not weak enough for us to want to bail. So we're holding on to our longs as much as we can, using the short hedges, but we're also not aggressively going short because I don't think we're going to be in a big pullback here, not unless something goes really wrong. All right. So blah, blah, blah. Okay, so if I want to clarify, my best way to clarify what you should be using is use what just use a lot of different things. It's, you're all averaging, and the more data you have, the more times you average the peaks and troughs and so on and so forth, even if they're fairly arbitrary that you're using them, you're going to come up with a number that works because you'll see it. You'll start seeing that it works, and the more you practice, the better you'll get at it. All right, so hopefully that answers people's questions on that. And let me see something. All right, where were we? Oh, yeah, so back to the market. Meanwhile, this morning, I should probably, one thing at a time. Got so many things to talk about, like one thing at a time. All right, so this morning we talked about the lines. We looked at 16, well, no, those are 35%. Those are our traces. Here we go. These guys. 16.5, 1930, 3900, 1135, okay? Those are our shorts this morning. 1135, 16.5, 1930, and 3900. What do we have now? Not 39, 1130 on the dot, 1930, and 16.5. So we're back to where we started this morning. All right, in between, there's nice money to be made, right? Because we started out here, and in fact, when I was writing the article, we were here. We popped up a little bit of the open, which is what we know that's going to happen, and then we came back down. But as we crossed back down, that's where the money maker is. 5 points. 5 points is good money on the S&P. It's $250 per contract. Nothing to sneeze at. The Russell is, as usual, the most fun. So the Russell, oh, I'm sorry, was it 1135? 1135. So the rest of it was 1135. All right, and we went a little bit above it, but we don't care if it goes up. You know, see, we had in chat, we had a quick thing here. I told people to take money here because the NASDAQ was going to bounce off of here. So we had a quick thing here, but the re-entry came right about here, and then we get a nice little 5-point run here, and the 5 points on the Russell is $500. You know, we're not looking for big money. We just want to make some quick cash when we do these sort of things. Now we're back at 1130, and we need to say to ourselves, do we think 1130 is going to hold? Well, if you're at 1130 and you're over 3,900, then I would say I want to play that bullish. If you're over 1930 and you're at 1130, I want to play bullish. And if you're over 16.5, which you are, I want to play 1130 bullish. So at this very moment, I'm making 1134 bounce. All right, but we're already at 1131, so it's not a good entry. It would have been a good entry a few minutes ago. Yeah, oh well. Oh, here we come. All right, so let's take a quick look at the active. See, there's questions, guys. If we can move on to some other topics. But if I'm bored, I'll certainly look at the futures. Oh, okay. Well, you're welcome, guys. Some people are saying thanks for the last explanation. But let's come up with new topics. Oh, we're going to look for something to play look at oil. Damn it. See that? I wish you could pay attention to all these things at once. You guys got to tell me when something like that happens. All right. But again, this is a good example because it's something we just talked about, and it's exactly why you use these sort of 5% rule concepts. Oil. Where do we talk about that? There you go. Brent is down 1.3%. Oil prices are really collapsing here. Our oil's at 97.33. Another 0.6% would be down at 96.50 if it follows Brent. So what happened I said that at 12:31. What happened? Boom. Nice collapse, okay? Didn't even hit 90, didn't even hit all the way down. And in fact, I'll tell you why, because I was wrong when I said it. From 96.30, okay, another 6% down is 60 cents. So it really was 70. If this was 33 here, or what was it when I just made the comment? I didn't do the math. I didn't say it right, which is my fault. It was 97.33. So 6% of 97.33 is 6%, not even 60 cents. And so had I actually calculated properly, this is pretty much exactly what the 0.6% pullback would have been. So what we did here is we matched Brent. I made the comment here, and I said if we're going to match Brent, this is what's going to happen. This is what happens, and that's a hell of an opportunity to go long. And so even if you didn't know that, at least you're bouncing off 97.75 to get an entry. All right, but all that is doing is because we had to we probably contract had to square up with Brent. Brent closed down 1.3%. So as Brent closed, our oil fell 1.3% total, and now it's back to 0.88% for the day. I don't think you can see that's really tiny. Just about 0.9% here. Doesn't mean that we expect much of a bounce, but you expect some kind of bounce to go back because, you know, you see a spike like that, you say that's not going to last. You know, maybe we'll get to 96.50, but probably not. As soon as we start going up, it's worth taking a chance with a tight stop. All right, so that's how we played these things. Now, meanwhile, so oil, I don't see oil really getting. I certainly didn't. I said earlier, I don't see it going to 97.50, which is here. That wasn't going to hold. We knew that. I think oil is going to come back down to this level. So, but say below 97.25. So you get tight. So if I take a short here, all right, let's. Hello. I'm moving. I probably have to restart Thinkorswim. Oh no, there it goes. That was weird. Now, well, let me get out of it. Ooh, I don't like that. That's some very strange behavior. So let's restart this and then make sure I don't know one thing. All right, so anyway, so at this point you would have stopped out already with the incorrect play. But I would lean towards trying to short it below 96.50 now, but you want to get up to 96.50, otherwise you only make it short. Ah, you son of a bitch. Now, oh, I see. That's weird. So now it filled me short, but at way up here at 97.33, I don't even understand how that could have happened. That's very strange. All right, we'll leave that though. I am pretty confident that this is not going to hold. It's going to go down. All right, but tomorrow's inventory, so I sure wouldn't want to stay short of the inventory. So we'll see what happens. Meanwhile, watching the Dow. So if the Dow breaks 16.5, that's a good thing to take. The Russell we're checking out here, but if they hold, he's below. As long as the S&P is below 1930, I don't want to go long. Okay, so I'm trying. It's very tricky. You just want to try to have all your stars have to line up for you to make a trade like this. You don't want to just have one thing that tells you you're going to make a trade like that. So we shall see. But I'm leaning for this to bounce because I just think that's a little more likely than the drop. But he's not strong enough. He's not strong enough. And these guys are, he's 1 point below green, 1 Dow point below green, and they can't get that. That's sad. All right, and now he's 2 points below green. And meanwhile, if they can't get green, how come he's going up? All right, so to some extent, that's a little bit of a forced move. But I don't feel like playing with the conviction, so I'm not going to worry about it. And we'll talk about some other stuff. So let's move on. All right, but we will keep this short, and in theory, I would add, okay, well, here, let's make it so you have the signal at least. I want to get that sound. So we'll take another short at 97.50. I have one short at 97.33, so it's going to be 83 divided by 2 is 41.5. So essentially, if that fills, we're going to average 2 positions short at 41.5. All right, so that's the plan at the moment. But if I'm wrong and oil tests 97.50, you see how it shows up nicely? It's nice to have these on the chart. It shows me that I'm going to get shorter at that spot. So even if it spikes up there, if I'm lucky, I'll get my fill, and then it can start heading back down. But as soon as it gets my fill, hopefully we'll hear it in the headphones, and it'll be a signal. Oh, and there's Russell giving us the signal. Oh, we missed it. I just can't pay attention to futures when I'm talking to somebody. I don't know why. It's one extra thing that pushes me over the edge. You got to really concentrate on this stuff. All right, so so now here's the thing. Oh, this is a very good example actually. The S&P gave up 1930. The Russells gave up 1130. I'm sorry. Yeah, 1130 on the Russell, 1930 on the S&P. That means now I'll play the Dow. Wow, stop. There we go. Now I'll play the Dow as the laggard. I missed those guys, but I'm watching 3 things, okay? So when I say short the laggard, this is what I mean. All right? You're watching 3 indexes. When 2 of them cross, whichever one didn't cross is the one you're going to short. And then if either one of the 2 that you shorted crosses back over, you kill the trade because your premise is blown. But as long as the S&P and the Russell are failing their support, then my premise is to short the Dow to catch up. It's not that hard, right? I mean, that's all we're doing. We're watching 3 things that are crossing lines that we consider significant, and if 2 of them fail their line, it's very likely the third is going to fail too. And so you short whichever one didn't fail yet. And then if any of them cross back up, including yours, if any of them cross back over, then you give up on the play. And then at this point, though, you start counting. All right, so we're watching, and I'm making sure I'm like 0.6, 0.25, 8.25, and 9.6. I don't want to see either one of these going up. Okay, I want to see progress in my direction. Otherwise, I'm going to be inclined to get out of the trade. Don't lose money. You know, the more often you enter a futures trade and learn not to lose money, the more often you have a chance of getting into a futures trade where you make good money. Sometimes you'll accidentally have a really good run. But the more, it's like a lottery ticket, though. The more times you buy it, the more chance you have of getting a good run. But it's kind of like a lottery ticket, except when you're watching like the Powerball drawing. you have 6 numbers, right? And if the first one doesn't come up your way, you get to give the ticket back. All right, think of it that way. It's like I've got a ticket that says I could win up to $500 if the Dow drops 100 points. All right, I'm buying that ticket because I think we might be an inflection where the Dow could drop 100 points. But it's right at the beginning when I'm looking at, when I'm watching the indexes, if I see that the other indexes aren't heading down, because I don't think the Dow's going to drop 100 points if the other guy, but 100 points on the Dow is 0.5%, let's say. So I don't think the Dow is going to drop 100 points unless the S&P and the Russell drop 0.5% too. So if they're not going to drop 0.5%, then what the hell am I betting on the Dow for? So you've got to see that steady progress to the downside that confirms your bias. Otherwise, get out of the trade. All right, that's like that Powerball not coming up your way. It's like, hey, got the wrong number. Get out of the, take your money back then. The less times you lose $1, the better your overall win, right? So try not to lose money. Once you get into these trades, your goal switches to don't lose money. You always want to make money. You always hope to make money. But you don't play the futures the way you play a stock, because there's no such thing as a certainty of the future. You can't be sure what's going to happen. I mean, I can be sitting here, especially because right now I'm not paying attention to the news, so I don't know what's going on in Iraq. I don't know what's going on in Russia. I'm not watching the screen. You know, it's another thing. If I'm in an oil trade, I gotta watch the oil market. I gotta watch the oil news and see what's happening. If anything goes on that affects oil prices, I should get out of my trade. If it affects it positively, it's another thing. When you're betting oil, hang on, guys. When you're betting oil short, it's against your news is against you, because there's not going to be any news other than an inventory report. There's not likely to be any news that says a flood of oil was released, you know, and all of a sudden oil prices are being pressured down. That doesn't happen. What happens is a war breaks out, there's an outbreak, something spills, this or that, things that affect supply. There's not usually an instant thing that turns supply on that's going to be in your favor. So the bias of news is always going to be against you once you're shorting oil. All right, so you have to be aware of that also, because the odds are not in your favor when you take these trades. You've got to, you know, you're betting, what you're really betting ideally is that there's some kind of, quote, good news for oil that shoots it up. And then you say, I don't think that news is that good. I think it was good news, but maybe not that good. And since I don't think it was that good, I have a number in my head where I can go fall to. All right? So I didn't hear any good news to shoot oil up, but what I did see is a test of where we thought it should be because of the Brent prices. And what I'm looking for now is, as we come into 230, I'm going to look for West Texas crude to square up with Brent, or at least come halfway down. So halfway, my expectation is going to be halfway between 96.84 and 96.35, which is 97.10. So I'm going to be looking for 97.10 to fill me. So in fact, since that's already the number I know I'm going to be happy at, I can put in my buy to buy it back. Oh, look how far that looks. Ah, I love these things. So funny. It's like, wow, that's down there. Okay, it's only 20 cents down. No, wrong one. That's sloppy. All right. So my target is now set at, I want to buy at 97.10. Now, don't forget I'm short one. I'm not really buying. I'm buying back my short at 97.10. That will zero me out. Or if it goes up to 97.50, I will double down, and then I would move my buy up to where it would be even, which we said was 97.41. So if we do double down, even will be 97.41. I would want to buy back one at 97.41. Still going to be looking for 97.10, but I want to get out and have average my my oil purchase in at a higher price, my oil short in at a higher price. So in theory, in the next hour of me talking, one of these two things is going to happen. And so I have to just listen to the little beat sound, which is what I love about trading Thinkorswim. And I don't know if every futures platform has audible alerts or whatever, like they use Thinkorswim, but I love the audible alerts. It makes me very happy. I like when I'm sitting at my desk and typing and talking to you guys on the chat room, I hear those little beeps, I know to turn around and deal with whatever's happening. So one of these two things is going to be in the near future. All right. As we see now, we're over 11:30, and we're not making progress here, and that means we're going to kill this trade. And hopefully we can get out even, but I don't think we're going to. Let's see. Oh, that's good. Come on, down a little bit more. Thank you. Going to be lucky to get filled here. See that? Right away, people come in again. So somebody's pulling the floor here at 16.5. But doesn't that mean I can be long here? Whoops. Damn it. That means I can be long here. People are pulling the floor at 16.5. So if I see the essence, so let's us call a floor here. Oh, okay, there goes my fill. But see that? Now, tell me if it's confusing. Nobody's chatting, but tell me if it's confusing. What I'm saying is because it filled at 16.5, that means that the Dow went down. So I'm zero for the day. No profit, no loss. I just cleared out the day. Other than a $1.50 trading call. So the Dow went down and filled. I don't want to fill while the Dow is falling. I want to make sure it's holding. So I'm still not getting really good signals. Now the S&P got weak. Now the Dow fell again. So I no longer want to be long on the Russell unless it bounces. But if it bounces, then I want to go long on whoever's lagging to the upside. So the Dow's up, the Russell's up. Now it's the S&P that seems to be the one I want to bet to as it's falling behind the others. But now I'm going to take into consideration that I trust the S&P more than I trust the Russell or the Dow to tell me what's going on. So I'm not too keen on going long if the S&P is telling me that it's weak. All right, so that makes it more of a no play at this point. And that's a very important thing about learning how to play the futures. 90% of the time, you should not play. So that's exactly what I do all the time. And you guys think it's like so easy, but you know, when I make a call on the futures, it's because everything lines up. And that's when I tell you I see a trade. And that's why our percentage is so high, because I only tell you when I see everything lining up a certain way. I don't talk about the 100 times I look at it when I don't see it all lining up. But I look at it all the time, and when I see something really, really good, and it wouldn't be just this, so usually it's not just the levels, although the levels happen to be very good right now. They're really good levels to watch. But it wouldn't be just the levels. What it would be is levels plus some news that makes me think that people are going to get a little bit more enthusiastic. Now, there's nothing really going on today. At the end of the day, we have, well, 1 o'clock, we just had our 3-year note auction. I imagine that probably went well because people are nervous and they're moving the bond. So I'm sure the 3-year note auction went well. And then by BY, we had a little bit of a pop in the market at 1 o'clock. And at 2 o'clock, we have the Treasury budget. I don't think that's really going to be much of a market mover. So there's nothing really going on today. And tomorrow, though, the big deal is tomorrow we get Japan's GDP at night. And obviously, the third biggest country in the world economically, GDP matters. All right, so we'll see what happens there, but it's probably going to be very disappointing. So I'm not keen to have any kind of major long positions right now. I'll make sure we're well protected. That then brings us to our next topic. Let's take a look at our portfolios. So the new thing we're doing now in chat, I'm trying to remember to do this every day, and please remind me if I don't, but we're looking at, this is what, the short-term portfolio? So here's the short-term portfolio. So we're looking at a short-term portfolio, 132,000, up 32% for the year. All right, and what I care about is that 132 plus the long-term portfolio, because the purpose of the short-term portfolio is to balance the long-term portfolio. So together, I'm hoping they're fairly steady. I don't mind if they steadily grow, but I do feel like I think we set our, I think at the beginning of last week, it was a little bit about 716, and I said I'd like to we're going to start scaling back our positions, getting more to cash, if we can't hold a total of the two of 710. So I said if I lose $6,000, when I think I'm balanced, that I'm doing something wrong. All right, and I know that, your broker calculators, they'll give you your account data and your account this and that. It's, to me, it's all bullshit. I care about how much money is in my portfolio. So for me, the best way to gauge whether I'm balanced or not is to see whether I'm balanced or not. And so I just take the total of 2 portfolios, which was 132 plus, this guy's up 18.7% now, so 593. And I believe that's 24, right? So that's 624. So we're at 624, which is a nice progress from last week. So we're up about $8,000 since last week, and it's well over our 710. But of course, now that we get to 724, I'm kind of going to want to pull the plug at 720. All right, I want to keep raising that bar. I want to say I need to see progress. I'm not making money. Why do I want to ride this out? Not with a 20% gain on the year. These 2 portfolios started with $600,000. Now there's 724 between them. All right, that's our year. So, our goal is to make 20% for the year. We're August. We made 20%. We're done. Everything else is bonus money if we make bonus money. Losing it is just stupid. All right, so I want to be balanced and protected here. It didn't stop us from making trades. We still added a couple of things, but we're not going crazy. Our primary thing here is to just balance, and if we have an opportunity to sell premium, I'm happy to sell some premium, but it's balance, and more balance. That's all I care about is I want to be protected in either direction until we have a clear indication of which way the market's going to go. All right? Now, we're not doing a portfolio review, so I'm just going to quickly glance to see if there's anything exciting going on. Eagle is exciting at 131. Holy crap! How did that happen? To me, we were like about to give up on those guys, right? Woohoo! Look at that! Wow. I have no idea what's going on. Haven't even thought about that one. I was actually, we talked about it last week. I was saying I kind of want to double down on them and take a chance, but they snapped back real fast. Why did they snap back? Oh, material, okay. Yeah, so remember we talked about it last time. They had a prepackaged bankruptcy. The trick was to just sort of say, we talked about this last week. Let me get back to it because it's important. You got to focus on what's real. And last week, even now, this 250 put cost us $2 to get out of. All right? Why would I pay $2 to get out of a 250 put? I'm basically net 50 is what I'm giving this person back. If I pay you $2 for a 250 put, so I don't have a stock put to me, what am I doing? I'm refusing to buy the stock for 50 cents more. I hate this stock so much at $1.31 that I'm going to pay you $2 not to have it put to me at $2.50. That's stupid, right? And last week it was even stupider. I forget what the number was last week, but last week it was even stupider. And that was the basis of our decision. It was like, why would we pay this? You can't lose more than 50 cents more than that. If it goes to zero, you can only lose 50 cents more, which is 25% of the $2 you spend. So it doesn't make sense to do that. We collected 130, so our entry price on Eagle is 250 minus 130 is 120. All right, so when the stock was at $1, we were only down. Obviously you're worried it can go bankrupt, but the most we can lose on the trade is $1.20. All right, there's no logic taking $2 out of our pocket. All right, the net would be 70 cents because we collected 130, we're paying $2, we lose 70. And you say, well, you lost 70 instead of losing a potential 120. Again, there's that 50 cents, right? But to lose 70 cents on purpose and net 50 cents for the stock when it's at $1, that's just panic. That's all this is, and that's a problem people have because you're looking at option portfolios and you see, like, look at Native, down 84%. And people see an 84% loss and like it hurts your stomach, right? You see an 84% loss in a position, and you're like, oh, I'm a failure. Oh, I did something horribly wrong, all that, whatever. The reality, though, is Hovnadian is at $4. Okay? We sold the $5 puts for 95 cents. We sold Hovnadian, so we effectively bought Hovnadian. We promised to buy Hovnadian for net 405. So we promised to own Hovnadian in 2016 for $405, and it's currently $4. Why would we pay $1.75 to get out of that obligation? It would make no sense. All right? It's a tricky thing about options, and you have to get used to that you look at these numbers because, we take a risky position, and the crowd is currently panicking, and they feel it's riskier. Now, by the way, in this portfolio, and this goes for your broker portfolios too, in this portfolio is showing me the worst case scenario. So the bid-ask spread is probably very wide here. Let's take a look. So we're going to go, meanwhile, nothing is happening on oil. Let's change. But here we do have that weakness that we gave up on. So let's see, all products. All right, Hub. Okay, we shouldn't whistle into this thing. All right. So the $5 puts, the spread C175 is the worst case scenario. The spread is 130 to 175, and 162 was the last time anybody bought it. All right, and Hub at 395. We're not worried about that. We want to buy, and frankly, I'll buy more. If it gets cheaper, I'm happy to buy more. So don't let yourself get bullied out of positions. You have to, and the way you do that, though, is you have to have a conviction of what you're buying. You can't buy the option. All right, we didn't buy the option. We bought Hovnadian. I said, I'd like to own 4,000 shares of Hovnadian at net $4. I'd like to have $16,000 worth of Hovnadian stock. Okay, this is a $500,000 portfolio. Our allocation blocks are, we have $1 million in buying power, and our allocation blocks are $50,000 each. I'm making a 1/3 allocation commitment to buy Hovnadian for $4 a share. Well, then it was $16,000 of it, and as you know, actually it's even smaller. It's $16,000. It's only $8,000 of buying power used up. So we're committing nothing to owning Hovnadian. If it goes from $4 to $2, I'm certainly going to spend another I'm going to spend another $8,000 without even thinking about it to buy an average of 3, and at $1, if we buy 8,000 more shares for $8,000, then we'll have 16,000 shares at an average of 2. And we will then spend $32,000 to have 16,000 shares of Hovnadian at $2 a share. So my question right now to myself, to you, whatever, is do we want to own 16,000 shares of Hovnadian at half of today's price? All right? And if the answer to that question is yes, then why would I get out of the position? Because that's the ultimate goal of my position. In other words, if it keeps getting worse, I enjoy my plan. If it keeps dropping and dropping and dropping, I'm perfectly happy with that because I'll buy more and more and more until I own 16,000 shares at $2 a share. And I'll have 32,000, and don't forget, that's only still 32,000 in cash and 16,000 in margin. That's still only half an allocation block. That's my plan for owning Hovnadian. All right, so this is, you have to always keep it in your head, like what you really planning to do with the position. And there's another thing I like about power options, you can always make notes. Grab this little bookie thing, and you click on that, and you can put in notes. So if you don't remember why you're in a position or what you intend to do, it's good to put a note there. And it always is good to have a note somewhere about why did you enter a trade? What are you doing in this position? You need to keep that stuff in your head.
Actually, I'll put my, we should close the windows if we're going to go in there.
What?
You mean the one I just bought? It's got charcoal in it. Pain in the ass. Just let it out. It's fine. It's fine.
Things happening on the shore, don't put people up building another Malibu beach house. They do it all the time. They wash out the sea, they build another one. Are you still there? Someone's talking about charcoal. Uh-oh. That's not good. we have a charcoal commercial going on? Hang on, guys. Host is me. Hello? Test, test. Are we good? Where did I leave off? I'm a gas grill kind of guy, so I'm not sure where we are. It's hard for me to follow a conversation about charcoal. Kingsford. Okay. So where were we? Oh, yeah. So, maybe. So I hope I got that point across. So the bottom line is, I want to own 32,000 shares of, I'm sorry, 32,000. I want to own 16,000 shares of maybe at $2. I can't own 16,000 shares of maybe at $2. And yeah, don't worry about it, Francisco. We talked about this earlier. Apparently, all panelists is not an option. So it's just I'm going to read questions when they come across. I mean, all participants is not an option. I don't understand why. I really don't. I have all participants, so I'm going to stick with that. So if I scroll, that's one of my choices. I don't know why it's not your choices. Anyway, where was I? Oh, yeah, Pubnavian. So I wish I could buy Pubnavian for $2. I can't. So initially, at 5, or when it was around 5, we sold the $5 puts $4. Right? I mean, no, it was 95 cents. Let's forget that. So that gives us a net $4 entry on 4,000. That's $16,000, right? But this is where it gets hard, though. What would be a catastrophe? It's not a catastrophe to me if my 4,000 shares of maybe drop from 4 to 3. This is not a life-changing event for us, right? That means we're down $4,000. And as you know, what are we going to do with 4,000? What are we going to do at $3 if we own the stock? We're probably going to change it into a buy right and knock $1 off our net price anyway. So, oh, something filled. Hold on. Stop everything. I don't know if you guys heard that noise. Something filled on the oil trade. It's exactly what I do when I'm talking to you guys in chat. Oh, son of a bitch. It was not a good fill. Oil spiked, so I'm now going to get rid of this. And we filled our second short, but we filled it in a very bad way because we caught it on the spike up. All right, so I don't know now if there is any kind of news that caused oil to pop. And as I said, that's your big danger when you're doing this kind of thing. Because I don't know if there was any specific news that made oil pop. But it looks like there was. If it goes over to 75, we've got to get out of this trade before we lose too much money. But you see that? There's no time. It popped over the line, but it failed at 75. But unfortunately now, I want to get out at 41. And I'm not sure that's even going to be possible. Look how far down 41 is now. That's my average. So I know for sure I want to buy at 41 and get back to one short position at 41. But my premise is blown. My premise was it wasn't going to go over 97.50. It flew over 97.50. All right, so that's not good. I'm not happy about that. And I'm down $500, so I'm not happy about that either. All right, but at least it stopped at 97.75. That's our next minor resistance point. But if we only get it now, back to the 5% rule. All right, let's talk about that. So let's call 96.75 was the bottom. Even though it didn't hit it, that's still the bottom. All right, that's where we expect it to be, and also it happens to be where the full green line. So 96.75 to 97.75 is $1. Therefore, 20 cents back is 97.50 is a weak pullback. And again, the shorter the term, the more we're going to use those spikes and whatever. So we expect if there's a $1 run that we go back to 97.50, and if we're lucky, 97.30. And look how that is. 97.30 works out right to be. That's a strong pullback off of this top. Takes you right back to that green line here. That's the S1 support 1 long. All right, so the good news is that 97.30 is below my 97.41 average entry. So I still have a chance to get even here. Okay, so on a strong retrace, I have a chance to get even. But if they have support here at 97.50, that's not going to be good for me. So I may have to consider lightening up at that point. So let's take a look and we'll watch it for a minute and see how it goes. But yeah, that's the problem with futures trading. If you can't afford to lose $500 in 10 seconds like that, don't play. Because there's nothing to stop you from that happening. You know, there's nothing on earth you can do about it. That thing spiked up and went right through it wasn't a stop. It went right through my spot where I thought if I doubled down to 97.50, I'd catch it or bounce back the other way. It didn't. It took my order and went boom, flying through. Now, I don't usually leave an order laying around like that, but I did it because I knew we were going to be moving from screen to screen, and I wanted something to alert me to tell me what's happening. Ordinarily, if I was looking to get in at 97.50 and it topped like that, I would have gotten in, and I would be in great shape. I would have gotten in 97.75-ish because I would have made my move here to get in when it ran out of gas. You know, in the very least, I would have caught it by here at 97.70. That would have moved my average up to 97.50, and I wouldn't be in bad shape right now. All right, but it's because I wasn't paying attention. That's why you can't play like that, and that's why you don't use hard stops on oil. In fact, it's very possible that because I had my order in, that's why they popped it. They were hoping to catch my order and force me to get out. And don't think that's too petty to happen, because these programs, it's not like there's a person on the NYMEX sitting there watching my trade, but there is a bot program running watching my trade. And that bot program is thrilled to make $200. Absolutely thrilled to force me to lose $200. Because it can do that to me, and it can do it to 1,000, 10,000, 100,000 other people all day long. And that's where the money gets made. So these bots drill down to the individual investor, and they look at every stop and every place that they can flush a trade. The Clippers. Oh, that's right. I got to read these. Now I realize I got to read all these. So Pat says, can we short the LA Clippers? The sales just went through to Steve Ballmer. Yeah, pretty much everything that guy touches. I don't know. I mean, I think he never was a tech guy, but he is a sports fan. You never know. He might actually do a good job. I mean, he loves basketball. I don't think he ever loved, being the Microsoft guy. But he certainly loved basketball. I think he loved the cachet of being the Microsoft guy, but I don't think he ever wanted to run a tech company. I don't think he even liked, I think he looked at like the people in the places like nerds. I think he was like one of those, like in Revenge of the Nerds, he was one of the jobs. He'd be like, nerds. So I don't think he had a lot of respect for the culture or anything like that at Microsoft. And that it showed, because it was years of like moving through the swamps over there. In a sports team, though, I think the guys in the development, I think he's going to be thrilled. And he's certainly got enough money to put it in his pockets and build a good team. Yeah, he happened to be Gates' best friend. I mean, I think Steve Ballmer was the guy who stopped Bill Gates from getting wedgies in college, and that's why he ended up with $20 billion. So it teaches you to be nice to nerds, I guess. Let's see. So now we got 97. Now see 97.50. But again, don't get hung up on numbers. I know I do this in check. I got to write something. I can't write issue all the time. You know, I said 97.50 would hold, and then we'd be in trouble. And 97.50 is holding. In fact, it held so well it never even got there. All right. So I'm not going to ride this out like an idiot. I'm going to watch this very carefully, and we're going to get out of this trade. I've got my one buy-in, but that's a wishful thinking buy. I hope it gets down there. All right, that's a good sign. See, the candle didn't hold, which is good. That's good, a little progress. And we're going to really test 97.50, I think. And it is now 2:06, so we got a little bit of time for this, but I would like to move on and do some other stuff. In fact, I forgot where we were in the first place. See, everybody's falling now. And that's another thing. So I'm looking, you know, if we look at this and we see everybody's pulling back a little bit. All right, so this is what we originally thought was going to happen. Well, if everybody else is weak, then I'm kind of a little less inclined to get out of this if we have weakness. But if we cross 97.60 again, I should. Because that means things are not going my way. No, they're not. Done. All right, 370 loss at the moment. We're going to kill this now. That becomes irrelevant. Now I have, well, now the average is screwed up. You have to be careful about this in Think or Swim, because once you go on both sides, it completely loses your average. So you just have to keep track of your own average. And so we're down 360. That's the key here. And so if we're down 360, that means I take 36 off 58, and I need 22 to get even. All right, even though this thing thinks I have an average price of 97.50, I don't. So now I know 22 is my even price. If we happen to double down at 75, that's going to bring my even price to 22 plus 75 is 97. Half of 97 is 48. So if it pops back to 97.75 and fails, I'll be looking for 48 to get out even. Let's go through with that. I still think this will come into play. We have a half hour till it closes. I am certainly not going to add another one short right now unless we get it. So my decision process here is I'm going to hold on to my trade. I'm going to hope that we get back down to the 97.20 and I can get like most of my money back. If it goes back up here, I'm kind of inclined to double down because I really don't think there's any justification for oil going higher, though I don't know if anything happened in the Middle East. In fact, if anyone knows what's going to happen that caused oil to spike, let me know. But I think this is just bullshit ahead of the close. All right. Rich says, how do you translate the index line to the future? You don't translate it. They're two different things. We have to just kind of hold them both in your head as separate events. I mean, obviously the NDX, the NQ index of the NASDAQ is at 3,900, and the NASDAQ composite is at 4,485. So therefore, there's roughly a 500-point gap, but it's going to be a proportional 500-point gap. So they're roughly wait a minute, 3,900, 4,485, 45, more like 600 points. All right, so sorry, so it's a 600-point gap. So 600 points off 3,900 is something like 15%, and that's going to be more reliable than the actual number because it'll change over time. All right, so but it's not something that's meant to be translated. It's not like metric and it's not like metric in English or something like that, measurement. It's just two different things. The NASDAQ composite, COMP, is the entire index of a couple of thousand stocks. The regular NASDAQ that you see, I'm sorry, got that wrong. The NQ listing is the 100. That's the 100 stocks of NASDAQ 100. The regular COMP is the entire NASDAQ, and that's the higher number one. Okay, so we're just tracking 100 stocks. Now, I like that. I like tracking 100 stocks in NQ because it means that I can, listen, keep my ears hooked up for any of the top 100 are going to have a big effect. Like if Priceline does something, if Tesla does something, if Amazon does something, I know it's going to have a big effect on my NQ. And that's good because I want to be able to have an index that's going to have a big effect when something happens. I want to know what's going to be going on. I don't want a NYSE with 6,000 stocks. I don't want the Russell with 2,000 stocks because no one stock is really going to do anything. So I have no advantage for reading the news. Reading the news on one stock isn't going to tell me anything about what's going to happen to that index. But with the NASDAQ, with NQ, if I know Apple's doing something, then I know NQ's going to do something too. I know it's going to go the same way. So there's the advantage to trading like that. And no, you look at each, and he says, you look at the index, not the futures, to establish lines. No, there's different lines on each one. So when I talk in the morning about we're following the NASDAQ, I'm talking about the NASDAQ, the one that's on the big chart. When we're in the futures, we're watching the composite. Why? Because that's what it shows. If they had the other NASDAQ, I'd probably use it, but that's what shows in the futures. And again, it's easier to trade and make money on because I can use the news to my advantage when I'm trading it. All right. So see, now the money comes in on the other index. It's so annoying. And now we're testing that 97.50 line. All right, and we've got 18 minutes. Well, not 18 minutes. We'll probably at 2:35 the NYMEX closes. So my theory is still that in the next 18 minutes we will go back down to about here, roughly. I'd say about there, about 15 line. All right, so it's possible to take more shorts below 97.50. I just got out at 97.60, so I'm not really inclined to. I could have wrote it down. If 97.50 is holding though, and these guys weren't weak, I would get out. But the indexes are weak, so I'm not inclined to get out of my short position on oil. Why would oil go up when everything else is going down? Unless, and I'm counting on you guys, unless somebody heard something about why oil should be going up at this moment. But I don't think that any particular news happened to affect that. And meanwhile, by the way, I see the Dow's down 30-something points. The NASDAQ is down 15 points. The Russell's down 10. The S&P's down 7. This is not good, guys. We're failing those strong bounce lines. All right, so we're not. This is not strong at all. We're not looking good on these futures, and that's going to make one of those ugly head and shouldery things if it keeps going down. So that's going to be a problem. All right, what else are we doing? Portfolios. When are we talking about portfolios at some point? We didn't get anywhere, did we? We talked about one stock. Anyway, so again, I love power options because I just like the way I have all these different things to look at. And I look here quickly. Who am I losing any serious money? This one doesn't matter. It's wedged. It's part of this trade. So this cancels that, and I'm making $2,900. These I don't care about. Don't care. Don't care. Don't care. Don't care. Okay. So none of these we care about. And that was, there you go. Now we've reviewed our entire long-term portfolio. Fantastic. Now, in the short-term portfolio, we have shorter time frames. We need to care more. Should we add the, Jim is asking very appropriately, we have our SQQQ hedge. Should we consider adding since they're failing the bounce? Okay. What do we have in SQQQ? Yes, that's what we like to have. We're currently down $2,600 because we're not hitting it on our longs. So I'm not really necessarily looking to add to it because I think we have a pretty good hedge here. We have a hedge that we spent about $6,000 on, okay, and it pays, let's see, that's 7 times 40 is $28,000. So there's a $28,000 upside if SQQ hits 50. 50 is 20% higher than where it is now. It's at 40, or I'm being generous, but let's call it 20%. So figure a 7% drop in the NASDAQ between now and December will pay us $12,000 will pay us a profit of $22,000. So I am not inclined, $22,000 is a lot of money. I'm not inclined to add to that because we still have our DXDs for October, All right, so if I was going to add something for short term, I'd probably adjust to DXDs. DXD is now at 26. These are the October 25, so essentially these are in the money, and they're going to reflect whatever the Dow does between now and October. So I wouldn't adjust this because this has such a huge payoff, and again, it's an insurance policy. It's not about. We took this insurance policy in early August. It's declined in value by $2,200. All right, but that makes sense because it's a $6,000 policy. That's good for August, September, October, November, December. It's good for 5 months. So it's going to lose. It's going to lose $1,000 plus a month anyway, $1,200 a month anyway. That's the rate of decay of the insurance policy. Even if everything else is equal, we paid $6,000 for the insurance. All right. The question is, are we still comfortable with the range that we're protected in? And the range for SQ2Q is 40 to 50. All right. And this was, it was cheap insurance. We bought this insurance policy to protect our much bigger upside plays. So SQ2Q. All right. It was never, when we bought it, it was here. Now it's here. All it's doing is decaying the premium that we paid because it's flat. All right, our premise is that we're going to pop this line and hit this line between now and December. Well, that's the insurance policy. Notice how that's going to be for the next, how many of these things? 1, 2, 3, maybe 4. So for the next month, this line is going to be very hard for this line to go above 50. It's going to basically, in a month or so, this 200-day moving average will be at 50, this line. You can see it here pretty easily. It's hard to imagine here that it's going to drop like that, but this thing's on a path to fall to 50 in 4 weeks. How long is 4 weeks on this chart? That's the distance. So we're talking about here. All right? So in 4 weeks, if we're not at 50, we're going to have to probably do something about this trade because it becomes less likely that we're going to hit it because now this becomes resistance, and the resistance goes below our target in 4 or 5 weeks. So we already know that's going to happen. So in the meantime, how much is it going to cost us to keep the insurance policy? It's going to cost us whatever we have left. All right, so what do we have left on this trade? There it is. We have net 4,000 left on the trade. So all you do is go to 0. So the most we can lose is 4,000, and for 4,000 we have $22,000 worth of, I'm sorry, $28,000 total of upside protection should there be a disaster. Well, that's what it's for. It's insurance. You don't get, if you have a shore house and you're insuring it against a flood, against getting washed out to sea or something like that, and it rains, you're not going to collect. This is rain. A little teeny pullback in the market is not going to trigger our insurance policy. The insurance policy is there in case something bad happens. Now, because of the nature of our long-term portfolio, because we're being the house and we're selling a lot of premium to other people, as long as there isn't a disaster, then every day, every month, we're going to pick up a little bit more money, more of the premium we sold. All right, so not to put too fine a point on it, but basically, it's like we look at our long-term positions, we have an expectation of gains on each one. And in fact, I think that's also in power options. Let me take a look. We're in power options. Yeah, you see these expiration values? All right, so they show you, like these are projections kind of for where you're going to be if things go your way. Now, it's a short-term portfolio, so that's kind of iffy because we're betting all over the place. But in the long-term portfolio, we consistently sell premium. So you're going to see some pretty big numbers here by comparison, I think. And let's see. So in other words, if all goes well, here you go. So if all goes well, this 592 becomes 636. All right, so currently, it's a little confusing, but currently you're negative 11 because you sold a lot of premium. If you liquidate it, you're negative 9. But if you leave it alone, it'll turn plus 32. So unless there is a disaster, then the long-term portfolio will gain $32,000. Against that, we've hedged $6,000 we already spent on that spread. Can't lose more than 6. And what we know is that as long as the NASDAQ, well, not just NASDAQ, obviously, but as long as the indexes in general don't correct more than 10%, we're going to make this $32,000. That's the whole point of the hedge. I'm only protecting what I'm going to make. I'm making insurance against it. Now, how much do I think I can lose? Well, I think I can lose more than $32,000 on a 10% pullback. In fact, I can see lose $60,000 at least. And these are leveraged positions, so it could be worse. But I'm going to lose $60,000, so I need more than just $28,000 worth of protection. That's why we have the DXDs as well. And how much do we spend on the DXDs? We spend, back to the short-term portfolio. We have no oil while we're waiting. Yeah. And 97.50 is holding. That's not good. Here we are. So on the DXDs, we spent 50 times, well, call it $2. We spent $10,000 on DXD protection too. But this is more of a bet because it's in the money. And so this is more of a short-term bet. Now, last week when these things were $2, I said maybe we should take them off the table for $2 since they only last till October with good money. All right, now we're down to 55 cents, so we actually lost 45 times 5,000, whatever the hell that works out to be, but we lost a couple of $1,000 in change of value. All right, but that's okay because it's conceptually we're still protecting our longs, and that's why I was talking about the balance thing, though. That's why we keep looking at our values because on the whole, the short-term portfolio isn't about just those hedges. Those hedges are for disasters. They're for a really market catastrophe that we hope never happens. And since we hope that doesn't happen, it means we hope we lose the money. We spent $8,750 on these. I hope we lose it. Our plan is to lose that money. Now, given that I know I'm short, yeah, right, Jim. Jim said balance did everything good. That's like Karate Kid. So since I plan to lose $8,700 here, and I plan to lose $8,000 there, I'm planning to lose $15,000. All right. I know I'm leaning short here, and that means that I can add some positions here, like ARO, Cake, Yahoo, these short puts here. I'm adding some positions that will offset that. Now, I have a couple of bets also. I have a short bet on XRT, which is looking good right now. We actually are long on fast at the moment because we took away our short calls. We have a short play on Baidu that's working out fine so far. We have a short on Solar City that already worked out nicely. That's up $800 or so. And we've got that long on silver. That's fine. We like that. And we have a little short thingy on Tesla that's ugly. Okay, that one's ugly. Oh, that's pop. Right, that's just that one. It's a very small bet, though. Even though it's a small bet, we're still down $9,000. Stupid stuff. But we took a small bet because we're able to roll out of trouble on this. We have a long position in Tesla. I can't believe we have a long anything in Tesla. But we have an $80 long spread on Tesla that at $300 pays us $80. We have a short put on Tesla, and they pay us $1,500 here. And I'm pretty sure the net of the spread is 0, or less than 0 probably. It's 41 minus 21 minus 22 is 0 already, and minus 26. So that's this $8,000 was the net profit we came in with. So this trade was plus $8,000 in our pocket here, and at the moment it's 7.8 flat minus, so it's minus 3,000 something here. So we're actually ahead on the spread. All right, we had $8,000 out of pocket when we started the spread, and now if we want to cancel it out, it's going to cost us $3,000 to cancel it. That's okay. All right, we're going to give $4,000 back, and we're good. We're out of the trade. So this is not a bad trade, but even so, the point was we took these 200 short calls, September 200 in Tesla, and here's the point of this, because as the trade progresses, it's easier to see. Okay. TSLA. All right, so that little elevator, here it is. What do we say, September 200s? So September 200s are now $59, let's say. But don't forget, we're all the way out until 2016. So those were $59. These guys are 250s. This is $50 higher and basically on the money. We can roll to 2x the 250 calls. All right, and we can do that and sell more puts to balance it out. All right, so there's a lot of good things that we can manage like that. Well, thank you, Eric. Eric says oil's dropping. So, you know, we've got, and don't get, that's only a roll from September to January. So that's October, November, December, January. That's 4 months. So in 4 months, we can roll the short call $50 higher by doubling them down. Okay, so if we can go $50 higher then, and of course, obviously, we're going to double those down, and we're going to add more longs to protect it and sell more short puts. But the point being that we can roll up $50 in just 4 months. So if we roll $50 in, another $50 into 4 months later, another $50, another $50. Now it's up to like $400 before this trade breaks. Right? We don't want to. I don't want to double down with ways that we can get out of that by selling all the stuff. But you know, it's another one of those things that looks bad, but it's fixable. And the trick is not to panic about it. It's just like, okay, fine, so we'll have to fix it. Down 122%, it's getting kind of bad. All right? I would have fixed it already, but I think it's bullshit that Tesla's at 250. There's nothing I've seen that says it deserves that price. So I'd rather let it play out. All right, charts. Oh, I'm sorry, no, trade, active, futures is not active, active. Hey, fantastic. Oh, I'm so happy. You see, I wish I would have done. Now we're back at that point. See, unfortunately, we panicked out, so that's okay. You know, I mean, you got to stay out. I don't like the way it's looking, so that's that. But unfortunately, it did exactly what we wanted to do originally. It hit out of 41 targets. That now becomes that stop. Okay, because that's where we were even before. Now, since I got out, I'm not even. I'm down $130. But you know what? That's not so bad, is it? Down $130 keeps being down $400. So now we're thrilled to get out. Anytime this thing turns, it's probably going to turn here. So I'm not focused on getting even. I'm just focused on getting a good price. And as I said, 41 is too bouncy. I'm not going to like that. And we've got 7 minutes until the NYMEX closes. I'm still thinking it's going to get down to here. All right? The 5% rule doesn't give a crap about this line. 5% rule is telling us we should be down here. 97.11. All right, so we'll see what happens. Once that 25 line breaks, I'm going to be very happy. If it breaks. But I've also realized other people are using this line. So this line, you can see it too. Look at it. So there's plenty of other people using that line. And the question is, will they break? Are there enough of them to support it here until the last 5 minutes of NYMEX trading? And don't forget, what was our original premise? Brent closed 1.3% lower. So therefore, we thought that the NYMEX should close at least 1% lower, not half of what the Brent closed. That doesn't make a lot of sense. You know, oil is oil. It's all over the world, being sent on ships. The ships don't give a crap where it came from. And the guy buying the oil doesn't give a crap where it came from either. He doesn't go, ooh, Brent, that's good stuff. That doesn't happen. He wants oil. Okay, there are different grades and such, but realistically, oil is oil. And they want oil, they're going to refine it, make it to get. some people have refineries that work better with some crude than another, but that's not really the point. The point is there's oil, and they will go somewhere into some refinery. All right, so, you know, unfortunately, it took a long way around, but we're getting exactly where we thought we'd be. And I'm not just, this line doesn't look very pretty. And again, I'm taking into consideration the fact that I know the NYMEX is closing, I can see the volume spiking, it's all been downhill on the spike. So this was just a big fake so that they could sell. So in other words, one spike up, because that one spike allows them to sell and sell and sell and sell and sell and sell and sell into the close. It's the same fake BS that the market does. The same thing. What are they doing in the market in the future? They spike it up at the open. Same here. Here's the open, 9:30. The high of the day in the first half hour. Then sell, 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 sell. Spike it back up for the suckers and sell, 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 sell. This is a market where people are exiting. It's not a healthy market at all, and that's why I keep. And I'm sorry, I don't want to be depressing. I want to be real. I mean, it's not a good market to be buying stocks in, and it's not a good market to stop being cautious in. I don't like spending 2 weeks with a totally balanced portfolio that makes no money. It's boring. All right, now, I also don't like that we're not really taking a lot of day trades either. We're not taking a lot of day trades right now because who the hell knows? Look at the way this thing goes. It's unpredictable, so it's not a good time. You know, we don't have 80% winning percentages because we pick random things. We have 80% winning percentages because we wait. And some weeks, you know, when you go back, if you look under the portfolio tab, there are some weeks when we have 12 trades. There are some weeks when we have 50 trades. And the reason we only have 12 trades in a week, not that we have 12 trades this week or more, but the reason we have 12 trades in a week is because you're not sure what's going to happen. There's not that many obvious things. And as a discipline, we try to only trade things that are obvious. And if you stick to the obvious trades, it doesn't mean you're going to be right 100% of the time, but at least you'll be right more than 50% of the time. You know, I mean, you know, random trading, you'll be right 50% of the time, hopefully. And again, the point being, though, that even when we're right 50% of the time, because we're the ones selling the premium, that gives us like a 15, 20% edge. So we don't even have to be right more than half the time to make some pretty good money. Bourbon says, do you still like entering the OIH butterfly today, just catching up next week? Oh, sure, that's a long-term thing. You know, we added an OIH trade to the butterfly portfolio. That's a good thing to close off with. I'm going to jump down to this oil trade and take my loss because we've only got 3 minutes left and I don't want to spend it watching oil. I'll be really pissed if it goes up. See how that line's holding? So I don't like it. It kind of stops moving too. It's kind of weird. Oh, there you go. Oh, wait. There's a gift. All right. We will take it. Bye-bye. Done. All right. Down 90. All right. What the hell were we just talking about? OIH, right. Okay, so yesterday, back to, let's talk about 2 butterfly trades. Well, all right, let me go back. I can get back here. So last week, I think this was last week. Was this last week? Oh, no, that's old. Forget it. Sorry. I'm talking about China stimulus, but it wasn't last week's China stimulus. All right, where are we? Monday. So we expected to bounce on Monday. We got the bounce. That's not an issue. Butterfly. There we are. So I said before we lose the VIX again. Now what does that mean if I say before we lose the VIX again? It means that when the VIX is high, and it was dropping while I was saying that, when the VIX is high, we get better pricing for the options that we sell. The long options that we take, also we'll pay more premium for the longs, but since it's over a much longer period of time, the decay doesn't hit us as hard. It's good for us to sell short-term options into high VIX because we're getting a lot of premium that's going to expire over a short period of time. And that's why we tend to alter our strategies that way. Okay, so here's the actual trade that Burr is talking about. So speaking of the butterfly portfolio, before we lose the VIX again, that's what I meant by that. Before the VIX goes lower and we don't get as good a premium, let's go for OIH, which was 54.35. It's actually worse today. And so these little charts update on a regular basis. And we'll take 10 2016 calls at 270. So he took the $60 calls way up here. They're only for protection. They're only to protect and to preserve the margin requirement of the trade. That's the only reason they're there. I frankly, myself, would be fairly comfortable just trading the two naked options on each end, but that's margin intensive and so on and so forth. And the idea of the butterfly portfolio is to show you how to make these kind of trades without being a hedge fund. You know, if I'm running a hedge fund, I can trade both of these things naked. I've got tons of margin. If you open an account, frankly, if you have $1 million, I think it's interactive brokers, they'll give you 5 times margin in a portfolio margin account. 5 times. So you get $5 million in margin with $1 million of interactive broker. That's their standard deal. All right. So in that case, why would I bother buying the long? I have 5 times margin. You know, you don't need to use the 5 times margin, but because you have it, then you are able to make these trades naked, and there's no real cost to your buying power. And I'm sorry, there's obviously the cost to your $5 million of buying power, but in the buying power you would normally have with $1 million, which is $2 million, the fact that you're taking these risky trades would not impact your overall ability to make the trade. So I hope that's clear. And if it's not, just ask. But that only applies to those of you with $1 million portfolios who are willing to risk $1 million trading. So in other words, if you have $5 million, it's a great strategy. If you don't have $5 million, stick to the covered ones. It's a little safer. And the covered ones, and that's what we're teaching you. It's a nice strategy. It's the kind of thing you would do in an aggressive hedge fund, but in a less aggressive way. And that's what our butterfly portfolio is about. It's a great trade. We're just selling premium on a constant basis, and it's a very, very reliable way to make about 20% a year. So let's see. So we sold these calls. So all we're doing with these calls, we're selling $60 calls. That's like $6 higher, and we're selling the $48 puts, which is $6 lower. So we're giving ourselves about 10% on either side, and those become our backstops. In other words, if the stock drops 20%, we have a stop at 10% to stop us from losing money on the things that we sell. Now, within that, so we can't lose more than $6 on either side. So 6 times 10 is $6,000. Essentially, that's all we're doing is we're only putting $6,000 at risk on this trade. 10 times the 6 we could lose. All right, so we're spending 270 plus 360 is about $6,000. So we're spending about $6,000. We're risking a $6,000 loss. All right, and we're going to collect $1 here and $1 there is $2,100. So of the $6,000 we're putting at risk, we're collecting 33% back on our first sale. All right, and how many sales do we have? People, you know, this is really easy to calculate. What I'm going to do is look at my backstops, OIH. So my backstops are 2016, and Thinkorswim nicely tells me we have 520 days to expiration there. And I sold September calls, which have 38 days to expiration. All right, so I sold not even 1/10 of my total time, and that's how you have to think about it. So if I collect $2,000 for 1/10 of my time, that means I have the potential over the 10 time periods I have to sell of collecting $20,000. Against what? Against my $6,000 outlay. All right, and that's what I mean. That's why also I'm comfortable with naked sell there, because it's you know, I've got 2 years, 10 periods to roll this thing. All right, so if that goes bad, I'm going to roll it, and how much? And now another thing I'm going to look at is how much can I roll it for? Well, if I sell the, I don't know what it was, the $55 puts, whatever. All right, if I sell the $55 call for 80 cents. Then what can I roll it to that's 80 cents? Well, in October, that would be the $56 call. And in January, that's the $59 call. Now, wait a minute. I bought, well, I'm sorry. So naked, I just have to be confident that I don't see OIH going that much past where I can roll to. So I would look at the next roll, next roll, next roll, and I would say, well, geez, if I can keep rolling this in each period, and the thing about doing this from the index is I don't have a very big expectation that the index is going to spike 20% on me. Nobody's going to buy OIH. Like, it's not for sale. You can't buy it. No company's going to come along and suddenly wrap it up 50%. Also, OIH, the index, isn't going bankrupt and dropping 50% in one day. You know, the OIH won't, even if BP has an oil spill, maybe it's part of OIH, even if BP has an oil spill and their stock drops 20%, it's not going to knock OIH down 20%. Maybe OIH will go down 5%, 10%. But I've got a buffer because I'm working with an index. So, again, with an index like that, I might go with naked puts and naked calls and just let them roll and roll and roll and make my money. All right? But with the buffers, as I'm showing you here, just rolling out to January, I can get my 80-cent sale up to 59. I've got the $60 call. So I really can't lose any money. I almost have no chance of losing money on this trade because it's so easy for me to roll up to the point where my coverage kicks in, $60. All right, you guys get that? So, and again, I mean, it is our most conservative portfolio, the butterfly portfolio, and it also happens to be it might be our most profitable one. You know what? Maybe we should start a Phil's Butterfly World. It is consistently very, very profitable. And the other weird thing about the butterfly portfolio is we're using none of our buying power. Not none, but I mean teeny tiny bit. Here, cash on hand, buying power out of 100,000. This, by the way, this doesn't give you margin, so it counts the cash. We're using $32,000. We're using zero margin because everything is covered. So we're using $32,000 of buying power, yet we've made $24,000. That 24% isn't of what we use. It's of the whole portfolio. So we've only used, not even a third of our buying power, and we've made $24,000. All right? That's great. And also the cool thing about this portfolio is we just added two positions. We added BTU, not BTU, I'm sorry. We added OIH, and we added Walmart yesterday, and the Walmart trade is over here. They're all the same concept, and it's all about paying out over time, but we're spreading the risk across multiple positions, and they pay such a phenomenal amount of money that you don't need to overcommit. The reason we have the cash is because you could get blown out. If the market suddenly drops 10%, 20%, we'll get blown out of not one position for $6,000, but all of them. And maybe not 6,000 each, but if you think about it, then you got 1, 2, 3, 4, 5, 6 positions that could conceivably all lose $4,000, $6,000 at a time. So you could lose $40,000 on paper real fast. Not real fast, but in a 9/11 kind of thing. So even though you don't feel like you have a big commitment because you're only using $32,000 of buying power, you do have a big commitment because the possibility, it's in a black swan event, the possibility is always there. So I much prefer to not use a lot of my buying power. And don't get that total value here is 124 now. So we're using 32 out of 124, not 32 out of 100. So as time goes by, we add another and add another and add another because we've got more cash and we can absorb more of an impact. All right, but and again, we're not going to sit there like idiots and watch it happen. If it starts going bad on us, like Caesars just cost us money and we got out of that trade. It started going bad. It wasn't worth sticking with. We still like Caesars, and in the long-term portfolio, we sold the puts on Caesars. As we got out of this one, we sold the puts. So we're making the money up in another one of our portfolios down the road, if all goes well. But we stopped, but it became no longer a good candidate for this portfolio. So we couldn't rely on it to give us a steady rate of return. All right, so how do oil end up? I got to know. Oh, damn it. Look at that. Right where we wanted it. Just a teeny hair up there, Sue. Oh, well. Had I hung up for just another minute or so. That's why you don't ever trade futures when you're distracted, not even when you're on the phone. I mean, seriously, it's like when the phone rings, if I'm in a futures trade, I like to get out of it because that's exactly what kind of stuff happens to you. All right. So Burr says, why not use more indexes rather than stocks and more susceptible to bad news capitalism? Yeah, no, there's nothing wrong with using the indexes, and they're just boring. I mean, that's my main reason I prefer to use the stocks because you get paid more. So you don't get as good a return on the indexes, but OIH happens to be fairly volatile within its channels and therefore is worth paying. But if you try doing that with SPY, you're going to get half the returns that we get. It's safer, but you're going to get half the returns. And Jim asks, when considering rolling the shorts in the butterfly trade, do we wait until a couple of days to do the roll? Give me a couple of days for expiration, I think. Or is it price dependent? It is price dependent. It's also your expectation dependent. In other words, if BTU, for example, and BTU spiked down, where can I do BTU? Let's try Yahoo. What happened to my chart? Hello? All right. So BTU, not so much for that plan. So BTU is here, then it went down to here. At a certain point, I don't remember when exactly, but at a certain point, let's go 3 months. All right. I think somewhere we had an expiration, like maybe this one, July 21st, and we decided not to resell a call because I thought the BTU would bottom out here. I felt 15 was a good line for BTU, and it was. And I felt that it would start going up from that point, and it has so far. I don't really want to sell another call until we're at least back up to, like, what is that line, 17. So until we're back right at 17, I'm not too anxious to sell a call. If you look at the bigger picture, you can see 17 has been a pretty good line going across. And so I expect that we'll probably hit some resistance there. We did hit resistance at 16. That might be a bad sign that the stock really can't make it. 16 obviously in the later times after 17 began failing, 16 ends up being the next floor, and if 16 now becomes resistance and it goes back to 15, I'm not going to be happy, but I still think coal's a bit underpriced here. I think that if the market is not going to fail, then I think we should be starting to come back a bit on coal. It isn't happening. Could be longer than we think, and then we'll have to just capitulate and start selling again on the call. But at the moment, I'm kind of hoping we get another buck out of it and we can sell better calls. That's all there is to that one. All right, guys, running a bit long here, 2:48, so we're going to have to cut this thing out. Otherwise, it's very tedious to download those recordings. As it stands, everybody's looking a little bit weaker. This is not good. And, well, you know what I'm going to say? I'm going to say this thing doesn't look good. We've been, again, it's just a discipline. It's just, I know it's boring as crap. I know it sucks to not trade. But it's just a watching week. You got to see what happens. And the big deal is going to be tomorrow night. You have Japan's GDP. Thursday, you have Europe GDP. Those are going to be your market moves. We already know what our GDP is. We had a big rebound in GDP per, the BS early estimates, but we had a big rebound in GDP. If they don't have a big rebound in GDP, and they're not going to, Japan's sure not going to, I don't know about Europe, and I don't think Europe will either. But if they don't have a big rebound in GDP, then everybody's going to be disappointed, and the market's going to go down, and we're going to test a new low. We'll see where that low is, and then maybe we'll get excited about buying some stuff. But it depends on how bad the GDP is, why it's bad, what's happening, how bad the reaction is, how many people fleeing out. There'll be a lot of little things to do. Maybe we'll have a special seminar in between if we have to. So stay alert for that. EWJ puts. Well, we already did EWJ puts, so we held them through the bounce. So last thing that we're going to address, EWJ. Dun, 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 dun. Okay. EWJ. That's right, the sound effects machine that plays music and stuff. All right, like a DJ, you know, like a shock jockey, sound effects, different things. EWJ, we picked it up around 12, I think. We started shorting. It went down to 1163. I was not satisfied with my 1163. Oh, wait. It's in the portfolio, isn't it? So must be in the short term. In 25,000 portfolio? No. So must be in the short term portfolio. Now, if I felt really strongly about them, I'd be in the short term. We sold them. I don't think we sold them. Oh, you mean we got out? Damn it. Okay. I forgot we got out. I thought we held it. I know I wasn't so happy with the amount that we got. I thought we decided to stick with it, but I guess I wasn't confident. And rightly so, because it bounced. So on Friday, I guess we made enough money where I said take it and run. Oh, up 60%. Okay, there you go. Thanks, Deb. I appreciate it. So we were up 60%, and that's why we got out. You can't be up 60% with a call that's closing in a month and say, "Ooh, I want more money." That's wrong. That's just stupid. Unless you average a 60% return in your entire portfolio, then a single trade that's up 60% is going to improve your entire performance for the year. Right? You get that? So, in other words, your batting average as a baseball player, well, you get up 500 times a year. If your batting average is 350, you know, which is fantastic. Well, obviously nobody's got 350. But if your batting average is 350, and you go 4 for 4 on a day, which is 1,000, just that one day going 4 for 4, even though it's only 1%, okay, is going to raise your average. And at the end of the year, every time you have one of those little 4 for 4 days, whenever you have a big victory that raises your average, if you keep them, then then you're going to do better. But if you just let it go, if you insist on, you know, if you go 4 for 4, right? With a baseball player, you don't have a choice because you only get up 4 times in a game, or 5 times at most in a game. But if you go 4 for 4, the great thing about a baseball player with an average is you stop. You know, it's forcing you to stop. You went 4 for 4 today, good, and that's going to go in the books. You can't take them back. But when you're a trader and you go 4 for 4, like when you have a 60% winner in your hand, you know what traders do? They keep going. So the 4 for 4 guy gets up to the plate and says, I'm going to go 4 more times. Give me 4 more swings. And he misses. All right? And now he's 5 for 4. So his 1,000 average goes down to 800. All right? Then he goes up again. He says, oh, well, that's just one time. I'm going to do it again. And he misses again. And now he's 4 for 6. And he's at 666. He was at 1,000. He goes to 666. And he couldn't stop. All right? He goes, misses again, and then he's 4 for 7, and God knows what that number is. But he's 4 for 7, which is something like 60 or something like that, maybe 600. And then he goes at the 8th time, and he misses. He's down to 500. He swung away half his game because he couldn't accept 1,000. And now he's got 8 at-bats at 500 that is not going to help his average anything like 4 at-bats at 1,000. All right? You've got to take those small wins. It's a good place to stop this thing. Can't emphasize that enough. You've got to take those small wins. And our logic on Friday was we got a good spike down. We were coming into a weekend when it was uncertain. We were hitting the resistance here at the 200-day moving average. So it's a good time to take our short off the table because it expires in September. If you're wrong, you don't have the time to make it up. All right? So now the September 12th put is 34, but I don't have any particular reason. I mean, I know I think that Japan's GDP is going to be bad, but I don't know for sure it's going to be bad. And if I'm wrong, that trade gets blown out and there's no recovery. So it's a binary event. And I say it's a binary event where I probably feel 60% certain that Japan's GDP is going to be bad. But, you know, I know they did a lot of exports. I know the car sales were good. Japan is very heavily weighted to export. it's possible that it wasn't as bad as I thought. And so since that's possible and we're heading into a binary event that can wipe out, not just diminish, but essentially wipe out that trade, I don't think it's a good trade. I felt better about it when we crossed below, when we first took it, because we were crossing below the 50. And I felt that we were going to test the 200. That was the easy premise. This is in between. This is not an easy premise anymore. All right? Not only is it not an easy premise, but now we've certainly we've burned off, we've dumped the nervous Nellies have dumped out. So now we're going to have a harder time because now we've got buyers who came in over here. We're going to have a harder time getting rid of them on the way down. They're going to be less likely to panic out. These guys are going to be stopping out on the way here. Those guys are going to jump off the train. That's all. It's all weeded out now. All right, so the trade's not as easy. And again, and Jim Burgess says it makes perfect sense. We talk about this a lot, and I don't mind. Look, I don't mind when people bring the stuff up in chat. And please don't get upset when I talk about it back, because sometimes I'm more talking to the crowd than I'm talking to the one person who asked the question. But I'll say that a lot because somebody asked about stock, and it's like, let it go. It's done. We made the trade. We made a trade. It worked. We made a trade. It didn't work. Let it go. Walk away. There are 9,000 stocks we can trade. Don't get hung up on one. And I know how it works. It's just like a girl. You know what it's like? It's like a girl you got lucky with. And it's like, you didn't like her so much, but you got lucky. So you end up going back because you know it's possible. Instead of wasting your time. I'm talking about when you're in college or something like that. But anyway, so it's like you know it's something you can make money on. It's a trade that you can win. So you're kind of inclined to go back there rather than go back to a bar and try to look for a new one, right? Because it's easier. But she isn't right for you. So walk away. You got to move on and find the right person. Don't just keep going back. So it's the same thing with stocks. There's so many stocks out there, and if you learn how to look for them, yeah, right. So I'm essentially being your wingman here. It's like we're out there scouting for stocks, and when we see an attractive trade, we're going to make that trade. But there's so many out there. All right, it's like in fact, this is the reason we would go to Holyoke or Smith College up in when I was up in Amherst, because it used to go there. There were like 4-to-1 women in the bars around it. So that was like, why would I hang out at my bar where there's 3-to-1 men? we take a trip. So having a car was key up in college. You got to go where the odds are in your favor, and you have to make the moves to go where you want. All right. So it's the same thing with stocks. You've got to go to the sectors that make sense. You have to find the conditions that make sense, and there's always going to be something out there. And that's why getting back to cash is such a powerful tool. You get back to cash, you have the ability to play the field. You can go fresh, and you can sit back and relax and pick the trades that are going to work. Don't keep going back to the same one just because one worked. This is a great example of it. We traded high. A lot of people were in at 12-something. When we crossed the 12 barrier, I imagined a lot of people would stop out. They did, and they panicked out of the position down to here. But when it came down to the 200-day moving average, look how many people were interested up here. So when it got to that 200-day moving average, a lot of people start getting interested again. But now, we don't have that history anymore. This trade's dead. It's over. It was an easy 60% trade. Now we move on and find the next thing that looks easy. All right. So happy hunting, folks, and we will do this again next week. All right. Thanks, everybody, for coming. Appreciate it.